Hi everybody, and welcome back to video number 9 in chapter 16. And when we left off, we were looking at derivative financial instrument speculation. So on April 16th, 225, the company settles the option before it expires. To record the settlement, it updates the value of the option for the decrease in the intrinsic value of $5,000. You'll remember that was the $120 minus the $115 times 1,000, as follows. We have a debit to unrealized holding gain or loss dash income and a credit to the call option of $5,000. Now, the decrease in the time value of the option of $40, that's the $100 less the $60, and it's going to be recorded as follows. We'll have an unrealized holding gain or loss dash income debit for $40 and a credit to call option for another $40 credit. Okay, so now if we look at the journal entry to record the settlement of the contract, at the time of the settlement, the call option's carrying value is as follows. And if we look at the T account here, with the 5 entries that we've made, the balance is $15,060 debit balance to the call option account. The settlement of the option contract on April 16th is recorded then as follows. We're going to debit cash for $15,000, credit the loss on the settlement of the call option of $60, and credit the call option for $15,060. You can see that this is a bit of gambling on the part of the company. You're typically buying these derivatives from very experienced and knowledgeable people. And so it's been my experience that they know the market very well, and by the time they make a profit, it's rare that we make actual money on executing a call option. But it does happen. In this case, we had a loss. Okay, so the effect on income in this case is on March 31, we had the net increase in the value of the call option. That was the $20,000 less the $300 here. And then we had a decrease in the call option on April 16th of $5,040. That was the $5,000 plus the $40. And then when we settled the call option, we had an additional loss of $60, for a total net income of $14,600. So what are the differences between traditional and derivative financial instruments? A derivative financial instruments has the following basic characteristics. Number 1, the instrument has one or more underlying, and 2, an identified payment provision. Number 2, the instrument requires little or no investment at the inception of the contract. And number 3, the instrument requires or permits net settlement. The features of traditional versus derivative financial statements. So we'll look at the traditional first here. The payment provision, that's usually the stock price times the number of shares. No magic there. The initial investment is that the investor pays the full cost, and the settlement is that we deliver stock to receive cash. Pretty straightforward. Now, the derivative financial instruments, the call option, that's a change in the stock price, the underlying, times the number of shares, the notional amount. Then we have the initial investment is much less than the full cost. And finally, when we settle, we receive the cash equivalent based on the change in stock price times the number of shares. Okay, now we're going to take a look at hedges. Again, a very complex subject. Here, hedging is defined as the use of derivatives to offset the negative impacts of changes in interest rates or foreign currency exchange rates. Once upon a time, I became quite an expert at knowing the relationship between the dollar and the Japanese yen, which I really needed to do to make sure that my company was protected by hedging. So the FASB allows special accounting for two types of hedges, the fair value and the cash flow hedge. Okay. The fair value hedge, here, a company uses a derivative to hedge or offset the exposure to changes in fair value of a recognized asset or liability or of an unrecognized commitment. In a perfectly hedged position, the gain or loss on the fair value of the derivative equals and offsets that of the hedged asset or liability. Okay, let's look at an example of that, how we would present that. On December 31, Hayward Tire Fabricators holds an inventory of 1,000 tractor tires with a cost of $200 per tire. Hayward has been building an inventory of tractor tires in anticipation of demand for these tires in the upcoming spring planting season. Hayward records the inventory on its balance sheet at $200,000, 1,000 tires times $200 per tire, using the lower of FIFO cost or net realizable value. Okay, so the balance sheet's going to look like this. We're going to have current assets. Under current assets, we have inventory of $200,000. Hayward wishes to hedge its exposure to fair value declines for its tire inventory because the tire inventory is pledged as collateral for one of its bank loans. Okay, so to illustrate that, to hedge this risk, Hayward locks in the value of its tire inventory on January 2nd, 2026 by purchasing what we call a put option to sell rubber at a fixed price. Hayward designates the option as a fair value hedge of the tire inventory. This put option, which expires in 2 years, gives Hayward the option to sell 4,000 pounds of rubber at a price of $50 per pound, which is the current spot price for rubber in the market. Since the exercise price equals the current market price, no entry is necessary at the inception of the put option. Now, what are those journal entries? At March 31, 2026, the fair value of the inventory has declined by 10%. So Hayward records the following. The unrealized holding gain or loss dash income is debited for $20,000, representing $200,000 times that 10% decline. And the allowance to reduce inventory to fair value is credited for that $20,000. Now, the following journal entry records the increase in value of the put option to sell rubber, assuming that the spot price for rubber declines by 10%. So, the put option is going to be debited for $20,000, and the unrealized holding gain or loss dash income is going to be credited for $20,000. All right. Now, Hayward's going to report the amounts related to the inventory and the put option as follows. On the balance sheet under current assets, here we have the inventory, net of the allowance of $20,000 for $180,000 here, and the put option for that $20,000. Now, the income statement reports the effect of the hedging transaction on income for the quarter ending March 31, 2026. And here under other income, we have the unrealized holding gain dash put option of $20,000, and then the unrealized holding loss dash inventory of $20,000. Complicated transactions. Okay, so now the cash flow hedge. Now here it's used to hedge exposures to cash flow risk, which results in variability in cash flows. And we're going to report that as fair value on the balance sheet. And bullet point 2, the gains or losses in equity is part of other comprehensive income. So here's an illustration. In September 2025, Allied Can Company anticipates purchasing 1,000 metric tons of aluminum in January 2026. In order to hedge the risk, Allied enters into aluminum futures contract. In this case, the aluminum futures contract gives Allied the right and obligation to purchase 1,000 metric tons of aluminum for $1,550 per ton. This contract price is good until the contract expires in January 2026. The underlying for this derivative is the price of aluminum. So Allied enters into the futures contract on September 1, 2025. Assume that the price to be paid today for inventory to be delivered in January, that's the spot price, equals the contract price. With the two prices equal, the futures contract has no value. Therefore, no entry is necessary. So, what is the journal entry? At December 31, 2025, the price for January delivery of aluminum increases to $1,575 per metric ton. Allied makes the following entry to record that increase in value of the futures contract. And here, it's going to debit futures contract for $25,000 and the unrealized holding gain dash equity of $25,000. And that is calculated by taking the $1,575 minus the $1,550, $25, times 1,000 tons. Allied reports the futures contract in the balance sheet as a current asset and a gain as part of other comprehensive income. So the journal entries on January 26, Allied purchases finally the 1,000 metric tons of aluminum for $1,575 and makes the following entry. Aluminum inventory for $1,575,000, cash for $1,575, and at the same time they make final statement on the futures contract and records the following entry. Cash for $25,000, futures contract for $25,000, calculated by taking the totals. That looks like a good place to stop this video.